friends, this is Martin from Secrets, the channel for learning about trading and investing. Welcome to a new fundamental analysis basic series, a new series, and today we are going to look at the topic of inflation and how it affects the stock markets. Right? I hope this is going to be great learning. So there are a few things that we know before we deep dive into the inflation. And before starting with that, just a disclaimer: this is only for educational purpose, and this is not for expert, like a chartered accountant or economics PhD holder or somebody like of that nature, or a finance guy. So basically, this is for somebody who is not from the finance world, but he's in the stock market and would like to know about the basics of economics and finance related matters, right? So the expectation has to be set beforehand. So it's a basic that we are covering. So we all have heard about this GDP in the news channels and in the newspapers and everywhere we heard about. We have a rough idea on that, but let's look at what exactly is in a very simple terms. The definition for that is gross domestic product. Right? The definition also says that it is a final monetary value of the goods and services of a country in an year. Right? So it's a monetary value of the goods, right? So if if a farmer is producing certain amount, certain quantity of food and selling it at certain price, the quantity into amount would amount to the monetary value of that, right? Okay. And if there is a transportation price that is given to a logistic partner of the farmer, then that would be a service. So that both adds up to like that. All the entire goods and services that a country produces in a year, if it is the total of that, the final monetary value is what we call GDP, right? So we will come to know in the next slide why do we need to know about the GDP, right? So there are two things. One is when you talk about GDP, so you can see the graph now, it has been dipping since and gone to the -7 kind of levels after the COVID crisis in 2020, right? So the real GDP, what you call, is considering the constant price. So there is a basis here that is considered, and the nominal GDP is for that current year's, whatever the current price is there. So many times what happens is that suppose a farmer is selling in the previous year, farmer is selling 100 kg and this year the farmer is selling only 800 kg because he could not produce that much, right? But due to the inflation and the price rising, he might have sold it at a higher price with lesser quantity. So that kind of GDP calculation would give you raw signals, because it may indicate that the GDP of the country is collectively, if such price hike of the goods has happened, and then that collectively would give an impression that the GDP has actually increased. But in effect, the farmers' production has reduced. The goods have reduced in the production perspective, but it gives a false indication. So that is because we are considering we're not considering a constant price on a basis year, but we are considering the price of that year. So in order to overcome that, a constant price for a particular year is, so right now it is 2011 2012 is the basis year, and the prices of the goods at that period is fixed, and then the following years until the next basis year is calculated. Until then, that constant price is calculated, so that you have a real picture on what exactly happened. Does the GDP increase and the production also increase, or vice versa? That indication can be clearly got if the price is kept constant. If you're not doing that, vice versa, that is known as nominal GDP, and every year if you calculate. So that's something that you have to know, whether we are talking about the real GDP or a GDP that involves the dilution due to the inflation or not. That is one thing, and because of the factor that I had mentioned about. Now, India's GDP is around 200 lakh crores if you look at that. So but the real GDP, if you look at it, it is 135 lakh crores only. So there is a difference always between real GDP and real. Now GDP wise, if you look, we are among the sixth largest because we have a big population. So when you calculate the GDP, it does not indicate the real picture, right? We are not one of the sixth largest economic power in the world, right? We really are not that much high, right? Because of the population factor. So if our population is more, then there is a calculation in the economics where the GDP per capita is calculated based by dividing it by the number of the population of the country. So that way, if you look at, we are 145th in the world with respect to the economic growth. We are, instead of the normal GDP, if you calculate because of the size and the volumes of the goods and services, it may be huge, but the real picture comes in the GDP per capita. So that is something you make a note when you talk about GDP. The real GDP and the which is based on the constant price, and nominal, which is not based on constant price. GDP, which is not considering the population factor, and GDP per capita, which considers the. So this is what GDP. Few other factors I already mentioned. The real GDP is 134, and nominal is always will be higher because of the reason we know. So GDP per capita, if you see, it is 2,200 crores as of now, right? India's. So we also talked about the price, increase, and inflation can give a false image about GDP. Is why we have a nominal 2019 and 20 is the the upcoming planned basis here for the real GDP calculations, right? So that's about the gross domestic product, the GDP of the country. Let's move on and see what do we need to know about this GDP, right? So this is the obvious question that everyone would have, right? Who prints the currency? So not before coming to the currency, how did currency evolve, right? We all know that few centuries back we were having only a barter system where people used to do business based on exchanging the goods that they have surplus, and then seeking goods which has lack, or basic demand supply thing was of the economics was happening due to the barter system. Later the gold backed money came in. Gold came in basically. Gold was a precious metal that had certain value, and then goods were transacted based on that. Now after that, instead of carrying this gold and storing this gold is a costly affair. So in order to avoid that, there were promissory note kind of things. There were documents which said that this much of money is deposited with them, and so lend him this much money. That kind of transactions used to happen. So gold backed promissory notes came in, and after that came the actual currency printing. So initially the currency that is printed on paper or currency, or whatever is punched in on as coins, whatever, that currency actually were backed by the gold. So that much money was printed for that much money of gold. But that did not sustain, and we moved on to what we call the fiat currency. Fiat currencies are not backed by gold nowadays. Instead, there is a formula for printing that. So if government of India is printing money, that is based on the projection of the GDP of the country for that particular year, minus whatever money is there in circulation, what is the banks and bad notes and all that is reduced from that. So 1% of the GDP's projection is taken, and that for that year. So for that year's GDP projections, 1% is the money that is being printed by the Reserve Bank, so the central bank, the government. Right? Some coins are printed by the finance ministry, and government prints certain denominations, but RBI is the main authority who has got printers across the country, 4 or 5, that prints the currency. So that's about currency, but this formula is very crucial, right? So always the goods, if the country does not have goods and services that is being produced, and more money which is out of balance with what the goods and services, then there will not be any value for the money, and you will not be able to buy even cheap things. We will not be able to buy anything, right? Very cheap piece of cake, or 1 kilo of rice may cost you 1 million rupees. That would be the kind of situations if there is no balance between the total goods and services, that is the GDP. Right? If that printing is over, is out of balance, and then you print more, this is what happens. But during extreme crisis where the country need to pump in money, just like we had a COVID situation where we need vaccines and economic boost, and then unemployment, all of these around the balance, the government, extreme crisis, they will print the money. The RBI will buy the bonds from the government and then prints that money for that bonds, and government bonds. So that did not happen this time because we could manage without that. But countries like United States and many of the European countries, they printed money and then managed situations to solve this crisis. So we also have provisions of doing that, but generally money has to be printed on this formula. It has to be purely printed on the GDP. An extreme crisis, based on the government. So this balance, so the money cannot be printed just like that. So in 2009-8 kind of periods, there were countries in Africa like Zimbabwe had huge hyperinflation. That's known as we will come to know about inflation in the next slide. But where there was no value for money, people, even in Russia, when this USSR crashed, Soviet Union crashed, people could not buy a piece of bread with lakhs and lakhs of rubles. So money is overprinted by the government to handle the crisis, and there will not be, and the price also will increase, and inflation goes to hyperinflation, and there will not be any value for the money that is printed. Right? So this balance between money printing and GDP is very crucial. That is why we looked at what exactly GDP before looking at how we are printing the money. Right? Let's move on. Now we briefly touched on inflation. We said that if the money is not having any value and it is printed more than what the GDP is there, it will lead to hyperinflation. Right? There is no value for the money that is being, too much of money is circulating. So what is that too much of money? So inflation is nothing but the increase in the price. Increase in the price and the cost of the living, if that shoots up, what is the rate of increase of the prices of different items over a period of time in a particular country? That is the inflation of that country. So here we are saying that the inflation is an example of that is given. Reasons of inflation could be many. One of the reasons we already touched upon is currency depreciation. If the currency of the country does not have any value, then if money is printed without any balance with the GDP of that country, then obviously the price will increase. Right? And no amount of money that you have, people will not be able to, that price will keep on increasing, and people will not be able to buy anything with no amount of money that is there. That kind of situation is known as hyper. So that is one of the reasons. But that alone is not the reason of the inflation. So inflation can happen because of multiple reasons, others. So even when there is very, very good economic growth, so there is a concept of price elasticity in economics. There are concepts of, so everything works in economics works on demand and supply. So basically, when there is, for example, if there is an economic boom that is happening, right, there is a lot of money in there, the country is developing, a lot of money is coming in, business is doing good, everything is doing good. Still, it could lead to inflation, because when economic boom happens, surplus money is flowing in. After a certain period of time, the demand increases. The demand increase means price. Obviously, the price will also increase, and at some stage, there will be too much of money that is circulating. And the price is increasing substantially, and too much of money is there floating around, and then it leads to an inflation. Obviously, another reason is cost to push. Right? So when the raw material for manufacturing the items, right, becomes costly, then the manufacturers will increase the price, and then that price increase will lead to inflation. Right? So these are the three different ways in which inflation happens. So inflation always moves up, and then due to some control measures it cools down. Then again moves up and cools, just like price elasticity, the economic principle of demand supply match. Right? Inflation moves up and moves. So the optimal inflation levels that's recommended is 2% or something for the developed countries like US, Europe, and all that. Our country, India, is a developing country, and developing country, it is meant to be held between 2 to 6%. Now, our target for our GDP was to maintain it between 4 and plus or minus 2%. Now it is more than 6%. It is heading to 7%, 6.95 GDP inflation rate. So when that happened, that is where we have the central bank interventions that happen, right? So deflation is nothing but the reverse of the inflation, right? So price reduces, so people who are spending money will stop spending money, they'll save, and then price will reduce, and then inflation will reduce, and then so then again it reverses. That's what deflation is all about, right? So let's move ahead. So how do you control this crisis of inflation, shooting up, and then because of the multiple reasons that we talked about, due to currency depreciation, or due to oversupply and demand, our price increase, and then demand increase and all that, right? So that is basically controlled by either the central bank of the country or the government. So the central bank, we are talking about inflation in our country. So the central bank in our country is Reserve Bank of India. Reserve Bank of India has multiple methods and techniques, and of intervening in the market, the money market, as well as the banks. The banks is the backbone of the country, right? They only provide the money to the different businesses. They provide the money to the retailers, whoever is spending, whether it's business houses that is spending, or if it is retailers who are spending, they take loans from the banks. So the banks is the spinal cord of the thing, you can say. Reserve Bank controls all the banks. So banks, how do they do the business? Banks do the business purely based on lending loans from the central bank, and then that money is given as a loan to the retailers and business houses at a higher rate. So example, if you are getting it 4%, and then you are giving the loan to the customers or business houses at 10%, that difference between what they got from the Reserve Bank and what they are giving out loans, that is where the profit of the banks is there. So the repo rate is repurchase option rate. That is what it is, the full form for that. So basically that is the interest on the loan that is taken from the RBI. So banks take loans from the RBI, and then that money is given to customers, right? So that rate is increased, then banks will. So if that is not increased, then banks will have more money and they'll give more loans, and people spend more on money, circulating more, and inflation, price increase, and the inflation increase. That's how it goes. But if this repo rate is increased, what happens is banks will stop giving too much of loans, will increase the interest rate, because it's attractive to keep that Reserve Bank really, and they give more. So that when the people start spending less, and then price gradually decreases, and then inflation reduces. That is a technique. The repo rate is another rate that we come across. That is what the interest on the loan given to the RBI. So RBI also would give, like to have money from the Reserve Bank, from the different banks, right? So RBI will take the money from the banks and give interest to the banks, right? So that is the reverse of the repo rate, right? Now cash. So the entire money that the RBI is giving to the banks, full money cannot be given to the customers, right? So there are some things that has to be kept as a reserve, because banks themselves can go vanish one day. You never know, because of bad business or bad management, a number of reasons, right? Non-performing assets and all these things, right? So the entire money cannot be. So 1% of the net demand time liability, that is NDTL, demand and time, net demand and time liabilities of the bank. So net demand and liabilities of bank means banks will have money in their savings and the FD, right? Time is FD, demand is savings account. So these are the liabilities that has to be given any time or within a time back to the customers, right? They have collected money from the customers, so instead of giving the loans, banks will collect money from the customers as FD or savings banks, and then give an interest for that, right? And whenever the customer want, they will take their money back. So 1% of that current NDTL, that much money has to be always kept with the cash reserve ratio, right? So that interest is 4.5%. Means so right, 4.5% is that. So in addition to that, there is some amount that has been maintained within the bank in the form of bank cash, bonds, and gold, and all these things. No, that is right now around 18%. Right? So that is known as SLR, statutory liquidity reserve. So SLR, CRR, and another one is marginal standing facility. That is the loans that is taken by the banks from the RBI for a shorter term. No, that is 4.6 as of now. It always will be less than the reverse repo rate. Not reverse repo rate, less than the repo rate. Right? Because repo rate normally is for shorter term, but this is for yeah. So this is for short term, basically. So that is marginal standard. Then bank rate is the interest that is given for long term, basically not short term. That is 4 points. So that is also be less than repo rate. So these are all the different rates that is maintained by the Reserve Bank to manage. So basically, the banks are completely dependent on the Reserve Bank's rates, because banks get their chunk of money either as interest or as capital to lend it out. No, based on what these rates are fixed by the government, by the bank, by the central bank. So depending on that, they will decide how much more loans or less loans has to be given, and how much of interest has to be charged to the end users, end customers, retail customers, or small business or business customers. So that is purely different on how that is how Reserve Bank controls. Now when the bank is controlled, everything depends on the bank. The entire company is business. Business people do the business not with their own money, right? Not entirely. If they want to expand, they need capital, then they'll go to the bank. The bank is where the economic thing is happening there, right? So the banks reduce the rate, more business, more loans will be taken. Banks increase the rate, less loans, less spending. Inflation slowly reduces. That is how they control it. So the banks increase the interest rate. So Reserve Bank increase the interest rate means banks will increase the interest rate. Right? They will give less loans. So customer will spend less money now, as compared to the previously when the interest rate was not spiking. Right? So the money circulation is reduced gradually, and the inflation will reduce. That's all. So this is how. So there are many other complex parameters that is considered by the monetary policy board before considering using this instrument. They would have different numbers, but these are the very common thing when you talk about interest rates. The common measure, everything. The common measure is central bank. Whenever we talk about inflation control, it's the main key thing is the interest rate. Interest rate for the loans that is given by RBI and loans taken by RBI. Right? That is CRR and RR, repo rate and cash CRR. Other things are dependent things that we all see. Now, government also can directly control the inflation to some extent by increasing by the tax rate controlling, right? Because when the tax rate is increased, that spending will reduce, and then inflation will reduce, price will reduce. So that way also control can be done. Now, extreme situations, currency printing can be done in balance with the GDP. Right? Or based on the bonds or some. So that way also inflation can be controlled. So this the government can and the Reserve Bank does that. So basically the central banks and the government do have different methods of controlling the inflation, so that it stays within the limit. It's optimal, or it's in balance, basically. Right? So these are the common terms that we come across very often. Now, why do we talk about all this, right? Right now, we know that the foreign institutions are selling every single day, right? 2,000 crores, 3,000 crores, 6,000 crores. So they have been sending still since April 2021 till date, almost a year. At least 3, 4, 5 lakhs crores of money has flown out of the market, and it continues every single day. So why do we do that basically? Where did all this money came in? Right, when the market fall to the 7,500 level with the COVID to March 2020, that's where the buying happened, but so the foreign money came in. So when the COVID crisis started, the US government printed more money as a method of giving incentives to the business, unemployment, and so in order to handle all that, the government, the US government handled it by printing the money. And you print the money, then there will be eventually more surplus money in the markets. Business houses will have more money, so they don't keep the money with them. There's no point, because there is the interest rate is reduced. So there is no point in keeping that money, that is extra money that is printed and floating in the market. So that money will come into our markets, because we are an emerging market, right? So it's risky to invest in China, because the government is military, and people try to invest in emerging markets like India, Brazil, where democratic things are still there, and it is safe investments, right? So money will obviously come in. That's what happened. That is why we had the big rally of 7,500 to 18,500. Such mega bullish rallies happen when the foreign institutional money came in, right? But this is like price elasticity, economic demand supply thing, right? So eventually, when the money has flown in the market, it leads to inflation. So US inflation is now like a 50-year high or something, 8% nearly. That's way beyond. So when that happens, their central bank will take similar action. That's exactly what happened. They increase the interest rates. So when the interest rate is increased, then money circulation reduce. Business houses will rather prefer to have institutions will rather prefer to have the money in their home markets rather than here, because the interest rate is reduced. Interest rate is increased, right? So there's no point. So then they pull out the money, and then eventually the inflation will reduce and money will flow back. That's exactly what you see there, nothing else, right? Well, this week we had the big crash. Why did that happen? What's the relation between inflation and that? So first of all, the RBI policy review meeting happens every month, right? And say for 6 times or something, they sit together, and then so they decide whether it has to be monetary, the interest rate has to be increased to, what has to be the CRR, what has to be the RR, repo rate, and CR, cash reserve ratio. All these decisions are made periodically, and so similarly they do that. So they're supposed to have done that in June now. Now before that, as a surprise, one fine day they came out of the way and then came out because of the situation. So RBI constantly studies the situation in the market, studies the inflation rates, the GDP rates, the currency, depreciation, appreciation, all these things, and then whenever they get the alarm that this is the right time, they came in. And they came in as a surprise to the market. Market was expecting that in June, right? But it came in before that. So that is one of the reasons. So when the RBI policy surprise came, then obviously the rate of the bank's rate increase happened. Banks will obviously inflation will reduce slowly, and money circulation will reduce, and that's not good for the market. So people have to spend money, people have to invest money in the stock markets. Instead of that, people will prefer to put in the bank, means gone. Right? People not banks will not give more loans, more money. So, right? So that's not great for the market, stock markets. That's one of the reasons. But that crash may be due to multiple reasons. So inflation can happen in multiple ways. This is one way that happens when our rate of interest rate. Now US, the mother market, and the dollar, the biggest, strongest currency, right? The base currency of the world is for the US. The US had an inflation rate of 50-year high of nearly 8%, and the Fed hike was recently. So because of that, institution obviously pulled out the money. We already seen that last slide. Right? So US market, our market interest rate, US Fed rate, inflation, then Russia-Ukraine crisis, and the oil price increase obviously following that. Right? And all of these reasons combined together caused the small crash. We cannot say it's a crash. Probably it may dip little more, but yeah. So that pullback, so that retracement or sudden surprise, effect of the last week's downtrend is primarily due to inflation, right? But Obviously, it's not just inflation. Inflation, oil, crisis, and U.S. other market inflation also. Not just our RBI inflation, right? Not just our country's inflation, but the U.S. inflation, right? And the oil price, and so collectively that is what exactly. So just to conclude to that, we have seen, how is currency printed, what is the relation that it has with the global, with the gross domestic product GDP of the country, what is GDP per capita and things like that, right? So how is money, is money printed just like that paper? Can you print this that? When do we need to know what is the impact of that? Now, then we understood what, if more money is there, we'll have trouble. Then we came to the inflation, and then we understood what all can cause the inflations, and then who controls and how do they control. We talked about the different types of interest rate that the central bank has, and why do they do that, right? What impacts it has got. We also came to know that, how why is the institutions pulling back money from the stock market right now, and why is the market having a dip whenever there is a surprise interest rate hikes in the by any of the central banks, either our central bank or the US central bank. What does it happen? Now, I hope you understood to some extent on the basics at least, right? So that helps you in some way. Consider it a like button and share to your friends. Thank you for watching. Happy trading, happy learning, happy investing.